Hey everyone, it's Wally, and welcome back to another video. Today we're talking real estate. Now, regardless of whether you choose to buy or rent, we all need a primary residence to call our home. And today I'm going to go over some numbers to compare buying versus renting to see what would maybe make more sense based on a specific scenario. Now, some key requirements to note: you need to be able to put down a 3% down payment at a minimum for a conventional loan, and you need a minimum of a 620 credit score. Now, the higher your score, the more likely you are to get more favorable interest rates, which would drive the cost to borrow money further down and making your monthly payments a little bit less. Now, just for this example, we're going to assume you're purchasing a 3-bedroom, 3-bathroom home that comes out to $225,000. That's the median home price for the area we're comparing here. And we're going to contrast that with renting an equivalent home that would rent for $1,650. The first thing I'm going to do is break out the cost for each of the two alternatives. The rent option is fairly simple with just that flat $1,650 a month fee. Buying is slightly more complicated since there are several factors we have to consider. The first one being that 3% down payment. And in this case, that comes out to $6,750. And again, that's for that $225,000 home that we're looking at getting. You're also going to have your principal and interest payment. That's the main part of your mortgage payment. And that, in this case, comes out to $920 a month. You're also going to have your private mortgage insurance. Now, this is insurance that you pay the lender so that they can cover themselves in case you default or are unable to make the payments on your home. And in this case, it comes out to $178 a month. Now, one way to avoid having that PMI payment is putting down more than 20%. Since we're putting down less than that, PMI is required. If you do have money saved up, you could put down 20, but you may want to consider using that for potentially a second property and utilize it as a rental. We can discuss that in another video to include house hacking. The other item you have to pay for is taxes. And in this case, it comes out to $339 a month. You're also going to have home insurance. And in some cases, you will have an HOA. In this case, we have a $27 a month homeowners association fee. So this was $79, and your HOA is $27 a month. All that comes out to $1,544 a month. Now, on average, according to some article I found on Google, people typically move every 5 years or so. So we'll compare the total cost for 1 year and 5 years of ownership versus renting. In general, if you aren't planning on staying at the property for more than a year, though, you probably don't want to purchase a home unless you plan on converting it to a secondary or investment property and renting it out as opposed to selling it. Now, the total for that first year of ownership is going to cost $18,528 in mortgage payments, plus the $6,750 initial down payment, which brings your total to $25,278. Now, over a 5-year period, you would have paid $92,640 in mortgage payments, plus that $6,750 down payment, which brings your grand total to $99,390. As opposed to renting, which would cost you $19,800 for that first year, and then for that 5-year period, you would have paid a total of $99,000. Now, just comparing these numbers purely, it looks like it makes more sense to rent. However, we'll go over what you get when you buy versus renting in terms of equity and appreciation in your property. Now, if you had chosen to rent instead of buy, you would have made those total payments over the 1 and 5 year period. But when you walk away with $0 in equity because all that money is just going to your landlord, whoever owns the property, to make the mortgage payments. Now, if you were to have bought, you're getting equity in two forms. The first one is in terms of appreciation, and the second one is in terms of principal paydown. Now, in terms of appreciation, on average, a typical home nationwide will appreciate between 3 to 5% per year, but keep in mind that that'll depend on where you're at and the condition of the year and what's going on. Now, for this example, we'll go ahead and keep it conservative, so we'll assume a 2% appreciation for the year, on average for the 1 and 5 year period. And for the principal paydown, throughout the life of a loan, you're going to pay both principal and interest, but the percentage of that payment fluctuates. So out of that $920, initially you're going to be paying more interest up front because the bank wants their money faster. And then over time, you'll be paying more in principal and less in interest until you've paid off the majority of your loan. So that principal paydown will fluctuate every month, increasing as you go through. However, we're going to assume a flat monthly paydown of $400 a month, just to make our calculation simple here. Now, for that first year, if you had bought and your property had appreciated by 2%, that would have gained you $4,400 in equity, as well as $4,800 in principal paydown just by paying your mortgage every month. Now, we also have to factor in the initial down payment because that didn't go anywhere, that just went into the equity of your home. So we add that in as well. And you come out with a total of $16,050 in equity. Now, over a 5-year period, your property should have appreciated by $18,550, assuming a constant 2% appreciation. You would have paid $2,400 in principal, plus that initial $6,750, for a grand total of $49,300 in equity. Now, if you look at these numbers, it's not straight liquid capital. It is equity tied into the home. So to get that money out, it is a bit of a process. You're going to have to either refinance or sell your home. Now, you could also refinance to get rid of that PMI to bring your monthly cost down by $178. So if you wanted to stay in the house longer than 5 years, you could use this opportunity to refinance and bring it down to closer to $1,300. Thank you all for watching. I hope you learned something or found this video useful. If you have any suggestions or feedback, please consider leaving them for me in the comments below, and I'll catch you guys next time.